3 surprising things you didn't know about the new tax law. That's today's episode. Let's dive into it. Hey everyone, I'm Clayton Morris.
I'm Natalie Morris.
And this is the Investing in Real Estate show where we help you build financial intelligence using real estate as the vehicle to build cash flow, passive income, and to hopefully help change your life. You know, the whole goal of this show, this channel, we try to treat it like an encyclopedia. You can go back to past episodes and you can really do step by step to build wealth and change your life. It just depends on how hungry you are, right? Some of you might be watching saying, I'm going to do all of this right now, and I'm going to change my life in a year to 2 years, or I'm going to spread it out over 20 years. I enjoy driving 2 hours to and from work every day, and I'm just going to spread it out. However hungry you are, all the tools are right here for you to make a change in your life. But today we're going to talk about the new tax law. You know, there's so many aspects of this tax law. Even if we talk to our accounting team, they're still digesting all of the changes and all of these little nuggets that are popping up, little loopholes that are now emerging as a result of the tax law. But we thought we would go through a few of them today that are kind of surprising.
Right, especially if you are running a small business or investing in real estate as a small business owner, then there are things that you can do differently now. And so we're sort of bobbing and weaving all the time based on the things that we've learned. So
well, let me just first say, you know, if you're new to the channel or you don't understand how to purchase real estate, we encourage you, and there's plenty of resources here on the channel to talk about how to purchase real estate in a certain entity or a business entity. So we're assuming that you are now educated to the point where you're making purchases in a legal entity like an LLC or an S corporation. We purchase real estate as a limited liability corporation, as LLCs. Because we do it as a business, now we get the full benefits of the tax code as a business that owns real estate.
Right. Because most people understand that the Trump tax plan, the new Republican tax plan that passed January of 2018, lowers the personal tax rate by about 2% across the board. So every one of us individuals has a lower tax rate. But for corporations, the tax rate has plummeted to 21%, and that's baked in, whereas some of these tax changes have expiration dates. The new corporate tax plan does not. So from here on out till death do us part, so help me God, the tax plan for corporations is 20%. So
21%.
21%.
Yeah, and that does the rest of this tax law. A lot of it sunsets in the year 2026. To your point, but that provision does not.
It does not. So we've talked many times about how we want to funnel our personal expenses legitimately through our company so that we are not only paying a lower tax rate because they're now business expenses, right?
Exactly.
Okay.
All right. So that's the introduction. That's the context for how you're going to be paying attention to this episode as a real estate investor, a smart, savvy real estate investor that's using business entities to purchase your real estate and structure and run your family as a business, right? We've had many episodes where we talked about running your family as a business, and we're going to get to a few key areas today on why this is so important. So what is number one? What's the little surprising nugget here that pops up in this tax code?
Okay, so something that I did not know is that business automobile depreciation has just about doubled. So depreciation is something we talk about a lot on this podcast, and it is basically you taking a tax credit for the usability of your asset, right? The government wants you to buy things like equipment to run your business, and then it wants you to buy it again 10 years later, but it understands that there's a lifespan of these types of things. And so it gives you a tax credit so you can get sort of a refund on your money, so to speak, on depreciation. Now, depreciation is an amazing tool if you learn to use it properly. And it used to be that you could only take so much on each vehicle per year. So the limits in the first year were $3,000. Now the limits are $10,000. So you can really accelerate the depreciation on your vehicles. Now, we can't just do it for like a minivan that we run carpool for the kids to school, right? It has to be a business vehicle, and your tax accountant can help you qualify it. But this is something to consider if you need a new car this year and you do use your car for business. You wouldn't get this depreciation expense. You wouldn't get this benefit if you leased a car. So
right.
Keep that in mind.
I was going to say that was my point I was going to make, which is this is for purchasing a car. So leasing, a large, backhoe or digger or some sort of big, I don't know what vehicle for your business, like a truck.
So aware.
I was trying to look for the word truck.
Okay.
I couldn't find.
I couldn't think of
digger.
the word benefit a second ago.
I was like, digger. Okay, no, truck. If you're going to buy it, you need to buy the truck. You can't just lease the truck for your company. So you run a small farm or whatever it happens to be, you need to purchase it, not just lease it to get the benefits of this depreciation. So, yeah, and actually in the tax code, there's all sorts of other benefits for like purchasing large SUVs and things like that. Now, I think under certain classifications, you can pretty much write off the entire purchase of these SUVs in the tax law as well. So check into that with your accountant if you need those or want those for your company.
Now, for rental real estate, you can now apply the Section 179 depreciation deductions to pieces of your real estate. So you definitely want to bring this to your accountant, because now these depreciations have expanded to include residential rental properties, roofs, HVAC units, fire alarms, and security devices. So if you are not getting depreciation for those pieces of your investments, you want to, right? Tell your accountant this.
Right. And so the tax code is very clear on the difference between repairs and maintenance. And so when you make a repair to the property that improves the lifespan of the property, increases the value of the property, or alters the property in any appreciable way. For instance, you bought a 6-bedroom house and you're converting it to a elderly care facility. That is altering the property. Those types of repairs are depreciable now specifically. So that roof that you put on that property is going to alter or is going to prolong the lifespan of that property another 20 to 30 years, right? Putting in new HVAC units prolongs the life of that property. But simply doing routine maintenance, I liken it to changing the oil of a car. Mm-hmm. When you change the oil of a car, you're not improving it. You're not increasing it in any value. Right. You're just doing routine maintenance. That is depreciable in the year in which you do those maintenance things. So these other items, though, the roof, HVAC, you can now depreciate over a number of different years.
Right.
Which is pretty exciting, thanks to the new tax code.
Exactly right. Okay, another thing I found interesting was that charity contributions receive state tax credits in many states. Now, it always was that you could get a deduction for your charitable donations. Like if I give $10,000 to UNICEF, right, then I pay taxes on $10,000 less than what I made. Okay, so I made $100,000 this year. I gave $10,000 to UNICEF. Now I'm only paying taxes on $90,000. That's a deduction, right? But now I can claim those charity contributions as a state tax credit in many states. I don't have a list of which states. I would assume New Jersey's not one of them, because we usually get screwed on taxes in New Jersey. But if that's the case, I'm going to be super excited. And so a credit is different than a deduction. A credit means you get your tax bill at the end of the year, you owe $100. If you have a credit for $50, you only owe $50. It's $1 to $1 off, right? Whereas a deduction just lowers the amount of taxes you pay on.
So you get the credit on your state taxes, and you get a deduction on your federal taxes. Mm-hmm. That's exciting.
So another reason to be charitable. Right?
Now, this next tip I'm really excited about. And so when I told Natalie about it the other day, she's like, most of the time she ignores me around the home when she was doing some dishes and things like that, and I was cleaning up in the kitchen. And I said, by the way, what were you shaking your head? I wasn't cleaning up?
You were not cleaning up.
I was clearly, or maybe...
You had one hand in your pocket and the other one on the text message.
No, I was looking at this new provision in the tax code, and I shared this with you. I said, did you know, by the way? And she stopped what she was doing. This is how excited she gets about tax code. And I said, with our family... with our children, we can now have this exemption for hiring our children and our business. It is now doubled under the new tax law. And she said, whoa, back up. Wait a second. What do you mean? So first of all, do you want to lay out what this was to begin with and what the change is?
Okay. So it used to be that children did not have to file a tax return if they made $6,000 or less in a year as employees, right? Employees
of your company. And these could be 2-year-olds that like you use for your advertising at your little car company or your linoleum flooring company, right? Where the kids are in the advertising going, hey, come to H&H Linoleum, and they're an employee, right? They've been used in your advertising.
You've seen these kids in local commercials,
right?
For local pizza shops, or
right. Come
your
to
dealer
Bud's
has
Pizza.
a baby.
My dad makes the best pizza.
Right, exactly. So you can employ your children in any shape or form in your LLC. Now you've got a business. That business needs people to make money, right? And so in our house, we use our children actually quite a lot. They do shredding, they do mailing, and we use them as models for Morris Invest as well for a lot of our marketing material. So they get legitimate paychecks. But I don't want to file paychecks for a 3-year-old or file tax returns for a 3-year-old, right? On $6,000. And so the government deems it just not worth their time to go and track down what happened to that $6,000. So we have 3 kids. They each have a paycheck out of Morris Invest for specific reasons, legitimate reasons. Now, they also have contracts. We have provable work, and they have a salary set. So the IRS has sort of flagged them like this is a minor. Why are they working? Why is money being funneled into their bank account?
And we proved it, and the IRS was like, great.
Right. We sent them their contracts, and they were like, okay, totally fine, because Brooke Shields was a baby model. She made money like a lot of kids.
We talk about our kids and feature them in videos. We talk about structuring our family as a business for real estate.
Right.
So they're a part of that entire process. Plus, we have them, like sending out mail. So we have to, they're putting stamps on envelopes.
They do shredding every Saturday.
They love going through all the old, stuff and just putting it through the shredder, old, I don't even know what you shred in that stuff. I don't know. Like just old papers.
7-year back taxes.
Oh, right.
I have boxes of stuff that it takes them a long time to get through it because they are not speedy. If I really wanted to hire a more efficient employee, I probably wouldn't hire them.
No, but I mean, look, if you have
but it needs to be done.
But if you've got a store or you've got a retail establishment and the kids come in, look at, hey, Robert Kiyosaki talked about working for the store, and coming in and having to sweep the floors and
rich dad.
Stock the comic books on the shelves, put the soda in the soda coolers. Those are ways that you can employ, at the local car wash. There's a guy, all of his kids work at the local car wash.
Yeah. And the bagel
employees.
shop.
My
dad owns a landscaping firm and also a green waste recycling. And so my sister and I would go. This was, we were between the ages of 12 and 16. And we'd have to pick through the pile. This large tub grinder would take green waste and it would be dumped into this humongous recycling thing. And we had to pick through it to make sure that there was no wiring or metal. And so we earned a paycheck from my dad from very early. Both of us, I think, from 8, we had the opportunity to work for him. We came home so filthy because you're standing under a tub grinder that's funneling dirt, and it's just going but look at me now.
Right.
It was not a glamorous job, but it was hard work.
Okay, so under the old tax law, $6,000 per child is what you didn't have to pay taxes on, right?
Right.
Now, guess what? That has now increased to $12,000 per child. So for us, that went from, what was it, $18,000, jumped up to $36,000 because we have 3 kids.
Right. So if you think of all the money that comes into our household, right, from our transactional business, from our rental real estate, from everything that comes into our house, we don't want to pay taxes on all of it, right? So we funnel a lot of it through the business, but now, if we can send $12,000 per child into their bank accounts, then that's $12,000 that, again, we're not going to pay taxes on because it never was our money. It was their money. Now, we have investments for them. They all have IRAs that they make specific investments in. Really, it's me that makes those investments because they're too young to manage it, but they will. But
using a self-directed IRA, which is a killer strategy.
Right.
Yeah.
So now this lowers our tax rate by $12,000 times 3, which is $36,000, right? Because it was $18,000. It just doubled. That's now $36,000 that we're not going to pay taxes on we're at the highest tax rate right now. So I was like, okay, those 3 are going to get raises. We should have more kids.
Right.
It'll save us $12,000 a year.
Let's get on it. All right, we got to wrap it up because we're going to go have some more kids.
We're not actually going to do that.
No, we're done having kids. But think about if you've got a small business and you have 4 kids and you thought, oh my gosh, I'm paying so much in taxes. Here's a way for you to really reduce your taxable burden by being smart about employing your children under the new IRS tax law. So
now, I want to be clear. I am not handing my 7-year-old $12,000. They're like, here, son, you get it, so I don't have to pay taxes on it. That money is still in my control, right? It goes into his savings account. But then what if I took it and paid a mortgage bill with it, right? Then I'm paying money that has legitimately come into my family with non-tax dollars. Right? I can do whatever I want with it. I could go to Hawaii. If Miles is in control of it, he'll book a Disney cruise.
Right.
Or
he'll buy comic books.
Right. So I'm not saying just give your kids more money at all. Like, you have to decide what your values are inside of your household. And if they had control of that money, it'd be a totally different story.
Right. So just be smart with it. Structuring a self-directed IRA, setting those up for your children, and then purchasing or investing in real estate, or lending it out to people who want to invest in real estate. You could lend it out at 6% interest into your kid's IRA, self-directed IRA, right? Imagine this. Imagine your son has a self-directed IRA that has 20 grand in it, okay? And you know that a real estate investor friend needs 20 grand in order to purchase a rental property. Why not lend that out to the friend at 6% interest, 7% interest, right? They're paying your son's self-directed IRA back with interest. And maybe you do it for a year, like a year loan or a 5-year loan. I mean, there's just any number of ways to create and improve your financial intelligence and lower your taxable burden. And the IRS wants you to do it. They're encouraging you to do it with this new change to the tax law.
Why do you think that is?
Well, because...
Why do you think they want children to be able to make more money through your...
Well, I mean, you could look at it any number of ways. These incentives in the tax code that you're setting your kids up for future success, maybe going to college, so that they're not in debt. I mean, one of the big problems right now is all this childhood debt.
But it's pushing money away from the government. It's saying we won't tax. Originally, it was we won't tax $6,000. That's a gimme, right? Now they've doubled it. So they're saying that's $12,000 in your house that we won't tax.
I don't know. I mean, you could go through this with a fine-tooth comb. As Tom Wheelwright likes to say, the tax code is just a series of incentives for entrepreneurs, right? It's a series of incentives. And look, entrepreneurs are savvy and they're paying a lot in taxes. Here's an incentive for an entrepreneur to lower their taxable burden. And maybe that's what this is.
Yeah.
I mean, the whole tax code is written for entrepreneurs. And there's only a small portion of it, 8 to 10 pages or so, that are written for you to pay taxes. The rest of the tax code are all of these incentives and loopholes. Not even really loopholes, but incentives. That's all they are.
So here's what I don't want is people moralizing in the comments about whether or not you should do this or pay your kids or this is cheating, right? It's clearly not cheating. We are playing the game as the rules are set out. We're not telling you to cheat anybody or do anything untowards, right?
Right.
So
and I just
keep that to yourself.
And I just did a whole video on why the tax code is written. It's rigged in favor of the rich. Okay, so go check out the video because I'm not pulling any punches in that video. And I explain why this is how it is. This is how the tax code is written. So you can choose to sit there and whine about it. You can choose to be upset about it. But guess what? This is the law. So it's not something I wrote. It's not something you wrote.
No.
But given the law, we're going to say to ourselves, okay, how do we keep more of our own money in our pocket as a business?
Capitalism is kind of a game of monopoly. Like, okay, if this, then that, then I'm going to do this. We're just, don't hate the game. Don't hate the playa. Don't hate either of us is basically what I'm trying to ask.
And don't try to figure out what she's saying either. All right.
And don't put hateful things in the comments.
Yeah, well, please don't do that. Be kind. We have great listeners and viewers of our channel here who say kind things and have a lot of thoughtful things to say about real estate investing and building financial freedom. So that's what we try to do. We give it away all for free to try to help you build financial freedom. So thank you so much for downloading and subscribing. If you think that this is helpful in any way, please share it with a loved one so they can start to build financial intelligence. Surround yourself with smarter people, okay? Instead of the people who think and just want to live by a paycheck and a 401k. Okay? That's not the way you build wealth.
Okay.
All right?
All right. Stop lecturing me about it.
All right.
I spend all my time with you.
Get out there, take action, become a real estate investor. We'll see you next time, everyone.